Everybody, I appreciate your listening tonight. This is the 15th of February, 2022, and it's going to be a little different than what we normally talk about. Sometimes we talk about technical analysis, and times we talk about fundamentals. We're going to talk about something even more basic, and it's economics, but more specifically about the time that we're in right now, which is why I shared the date. And we're not going to talk about the most impending issue or concern of today, which is actually Russia and Ukraine. We're going to talk about one that's going to be coming behind it. And I want everybody to be prepared for that. And that's China. So I want to share a little bit about China and why it's important. Why do we need to know about the economy of China and the importance that it carries on the rest of our trading? Well, there are a couple of things. One is it's the single largest exporter in the world. It's the second largest importer in the world. So if you don't think that affects the balance of trade of other countries, it does. And at some point, you'll often hear me sharing some of these things in the trading room, but I will, when I go through different sectors of the market and through different countries in the world, I'll oftentimes share with you, this is a leading partner of Japan, this is a leading partner of China, or whatever the case may be, so that when you hear things happening in those countries, you'll know that they're going to swing wildly one way or another. Especially valuable and important for those of you who are Forex traders. But it's also important because most US companies that are multinationals have partnerships, either buying products or selling into the markets in Asia. And so it's just important to know. And right now, it's actually a source of great stress for the developing world, which is where I spend a lot of my time, as well as the developed world. We think about all the issues of not being able to get products into the US from China, and China not having the capacity to buy everything that it used to buy, being the second largest importer. And now with rumors of them not being able to pay the bills that they need to pay, while they've been funding and building and spreading roots deep across the rest of the world, they're having their own kind of monetary crisis. That being said, their growth rate has been so strong over the past decade that they very well may crash, but they've built the infrastructure and the capital market systems that they probably will recover. When they do, it'll be strong. So from a trading perspective, that means opportunity. Whether it's on the short side or it's on the long side, there's going to be opportunity where many people didn't trade in China, or you traded the dollar yen or the dollar sterling or the pound or the kiwi, but many of you don't trade the CNY. You don't trade the yuan. And there's going to be opportunity for Forex traders to step into that space at some point in time and make huge money if you're on the right side of that and you understand when the fundamentals and the technicals are bound together. You can see long swings that last for weeks and weeks. So what I thought I would share with you today is built on it's part on a book, it's part on talks that have been shared by a fellow named Graham Allison. And Graham is something of an armchair expert in the area of China, but more, and you know if you've listened to me talk for any period of time, that I'm a fan of the Stoics, of the Greek philosophers and those who have shared, because a lot of the truths that were shared 2,500, 3,000 years ago are still applicable today. And that's the same with Thucydides. And so Thucydides, for folks who don't follow him or know about him, is I guess you'd call him the father of history. He wrote what was commonly considered the first history book, writing down the import of each country and each group of people and the wars that they fought and the politics and what have you, and kind of wrote a short history in a series of these short histories. And so Thucydides became famous for that, and for that reason has been called the father of history. There's a phrase that was created by Graham Allison based on what Thucydides called or what people have called the Thucydides insight. And Graham Allison has kind of reframed it and retweaked it to call it the Thucydides trap. And essentially what he's referring to in the Thucydides trap is any time that you have a clear and long-standing ruling power that's being confronted with an upstart rising power, you have an increased chance or an increased risk of war. And that can often be exaggerated or exacerbated by third parties. So sometimes both parties don't want war. They recognize we're a leading power and the other says and we're a growing power, and they want to find a way to work things out. But there's this natural tension that builds, and oftentimes other parties leverage that to create issues. And so many folks think that Thucydides trap is being replayed or is applicable in the US-China area. And then in that arena, you have this historical power of the US, which people would compare to like the Athens and Sparta, two powerful Greek states. And Athens being the strong, established government, and Sparta being the young upstart, one being heavily democratic and the other being heavily militaristic. And the military power grew quickly because they were organized and structured and had clear goals. And they started growing more quickly. And that was a threat to the folks of Athens, which was the beginning of what later became the Peloponnesian War. We don't get into all that. Some of it's boring, some of it's exciting. Movies have been made about that sort of thing. But the bottom line is market volatility goes up. Prices in those markets went crazy. They did in every instance since then. In fact, in the past 500 years, the thing that was interesting with Graham Allison is that he did a study and basically found that there's really been about 16 different events similar to that over the past 500 years. And of those 16 events, 12 ended in war. 4 did not. Interestingly, 2 of the 4 that did not were in recent times, which is a positive note, because maybe it means we're learning ways to discern third-party influence. Maybe we're learning better ways to communicate. But even those instances were a little bit scary. So I'll give you an example of one extreme and the other. In most recent history, in World War I, you had growing tensions between Britain and Germany, predominantly because of trade and certain other politic-related issues, but nothing huge behind that. And then you had a Serbian terrorist shoot Archduke Ferdinand. And because the Germans and the Austro-Hungarians and the other wanted him to be punished, and the Brits were supportive of the Russians, who were supportive of the Serbians, wanted to say, hey, this is a crazy person, it was an accident. That little, and it wasn't little, guy was assassinated, but that event is what triggered World War I. And I know most everyone studied that probably in high school or what have you. But when we look at the numbers of deaths from things like COVID and from other things, we don't realize how massive many of these world wars have been, how massive the number of people killed by the Maoist regimes, by the people killed in Cambodia, and in Rwanda and other places like this. But World War I was incredibly devastating. So this one event triggered by a crazy person assassinating a key figure, that war killed 25 million people. 25 million people. Can you imagine if an assassination did that today? It could potentially do that today. But I'll give you the other side of the story where there's some things to look forward to. John F. Kennedy in 1962 had been reading a book about World War I and how these third-party influences could actually have incredible effect on people in politics. And he happened to read that book at the right time, because then he was confronted later in October of 1962 by the Russian missile crisis. And he was already duly embarrassed by what was called the Bay of Pigs crisis, which was a horrible failure on the part of the U.S. government in trying to stop things going on in Cuba. But Cuba was an artifact country that was growing in popularity and relationship with Russia, and Russia was frustrated by this Bay of Pigs attempt by America. So they were sending missiles over to essentially say, hey, we're putting a wall right here that you don't need to come. We're going to help. We're going to strong defend this group. Very much like what the Japanese did once U.S. moved destroyers and battleships into the ocean near Taiwan. Once China created a flotilla to kind of stop people coming into Taiwan to put pressure on them, the U.S. kind of intervened by pulling ships in the space, intimidating China, and China backed off. But over the next number of years, what did they do? They built massive infrastructure to make sure that the U.S. would never come threaten them again. So until Taiwan separated on their own and what have you, China built a new wall. And so that's kind of what happened with Cuba. And so there was expectation of this nuclear war. And this is, I mean, it's as bad now as it was then. Nuclear still is as devastating as it has ever been. But if you can imagine nuclear warheads, not just missiles and ICBMs and what have you, but being dropped on US cities, the devastation that would cause. And if that happened in 1962, if you know about you follow the recovery of the areas in Russia that were destroyed by nuclear silos and their own manufacturing facilities falling apart from poor construction, what have you, and the devastation that caused in Russia still today. There's dirt that doesn't grow anything. There's people that have died of cancer. There's children that have been grown up with all sorts of maladies. And that's been decades. The same thing would be happening here. The US would still be suffering from that for something that happened in 1962 over 60 years ago. So it's incredibly, incredibly important to understand where that plays into things now, because China is playing its hand again, and it's looking to go after Taiwan. North Korea has its issues, and it is now partnering with China. And China has also gone out and built these roots, is the way they would look at it. Some people would call it tentacles, but others would say that they've put these roots in the ground, and they're known throughout Africa. And a lot of people don't pay attention, but they're actually known throughout the Pacific for coming into countries and lending them money like a loan shark, almost loaning people more money than they can afford to pay back, knowing that it's going to take longer than that country expects when they build a railway or they pave roads. You can't just pave roads and all of a sudden commerce starts the next day and you jump into a developed economy. People have to start building trucks. They have to create new legislation. They have to, people have to plant more crops and so on and so forth. It takes years and years and years. And so oftentimes these countries get behind the eight ball, almost all the time. They get behind the eight ball and they can't service that debt. And so China leverages their inability to service the debt to garner more value. How about, no import tax for Chinese cars. We'll call it even. We'll add what you owe to the end of the bill, and we'll go from there. And they can't pay it, the interest again in a couple of 3 years ago. How about this? How about we can export our vegetables with no export tax? So we're still buying your vegetables, helping you out. We just don't pay that export tax, and we'll call it even, and we'll just tack it on to the end of the bill. And so eventually, these countries build such relationships with China that China has such distinct advantages that no one else comes into the country. Other car manufacturers and car vendors can't sell because the price is such a huge difference, and they try to make up the difference for not making money on the cars from China. They added even more taxes then to import from other countries. So that creates an issue. Same with fruits and vegetables. China will often buy it. Some of it they use, and they buy whatever they can. And if they can buy more, they can turn around and sell it because they have the arbitrage between what it costs them and what it costs other people who have to pay the export tax. So those kinds of things have started creating these tentacles or these roots into those countries that they can't get out of. They can't grow out of it. And so as China's done that, and they've spent more money and more money and more money building roads and building bridges and building dams and what have you, and lending that money, while that model of you can't pay us back, well, we'll take more of this, you can't do this, we'll take more of that, that works fine. But at some point you still need money. You still actually need to take those dollars and be able to have them to run and operate your country. And they're at a point now where they're in a crisis. And if we had strong leadership, they would be pressing them and pressing them, and you would end up most likely with an outcome similar to what happened with Russia, where Russia essentially folds and they have to rebuild. But now it's the other way around. Japan, after World War II, was supported by us. We came in and helped them, just like Germany, and those countries are now superpowers. Well, the same thing has kind of happened with not much help from us, this time with Russia. And so Russia's built massive infrastructure and has built up their military and what have you. That being said, Russia can't afford to take another $1 trillion in pain like they suffered last time we put sanctions on them. So Russia, we're going to talk about in another instance, but I wanted to roll this into is, how does this affect markets? What does this do to us as traders and as investors over the next 3 months and 9 months and 12 months? Well, we've already seen an unnatural inflection in interest rates. This is caused by the US government way overspending money. Much like someone that only has whatever X number of dollars in savings for an emergency, and then that emergency is much bigger, right? I have enough money so that if I break an arm, I can pay for the deposit at the hospital. And then you end up having cancer and you have to pay a huge amount on and on and on and on. It's that kind of thing. We went through that kind of event, and because we had not properly planned, we don't build a savings model because we can print paper, we can print money. So it's an incentive when you can print money not to save. And so when we have crisis, we borrow from Social Security, we borrow from other groups, or we print money. And now we've borrowed from so many inside things, the largest pool being Social Security, that we now have to print more dollars to be able to do that. And when you have a massive global incident like this COVID crisis, we've just printed and printed. And once you start the printing press, why turn it off? So we've kept printing and printing and finding new places to spend money. And you have government agencies trying to find places to spend some of the money that they haven't been able to spend because we printed so much of it. The bottom line, though, is the value of that dollar is now shrinking and shrinking and shrinking. And so people are looking for more dollars for the same things because of all the inflationary pressures. When you add that to the change in policies on energy, where we're now looking to import energy, where we had significant energy on our own. And it doesn't mean that we're producing less per se, but it means the perception in the market is that for a long time, we're not going to increase production. And so a lot of the wells that we had that we knew we would support us for another 100 or 200 years or longer, we know that if we're not going to be able to tap those, then some of the production drops. But the perception in the market is that there's a limited supply, and we start subsidizing that. And why do oil and gas companies do that? Because they want to be around for a long time. So they start restricting price, knowing that, or start restricting production, knowing the price is going to go up. So now we see massive jumps in the cost of gas, and diesel, and jet fuel, which means travel is more important, logistics is more important. The cost of moving goods from one place to another is more important. And on top of that, we're China's largest buyer. So now we have a country that we have an issue with, that the cost to ship the product that we theoretically don't want to keep on buying, but we have to because we buy so much of it, we can't do without some Chinese products, barely can do without them. We now are waiting and paying much higher dollars to ship those products in because we don't produce them in our own country. And but at the same time, all of those countries have printed more paper, added more dollars, taken on more debt. So you have inflation globally. So people say, well, as long as, as long as they printed twice their GDP and we printed twice our GDP, it's kind of even. Yes and no. Relatively speaking, when you talk about Forex pairs, if Forex is the dollar versus the yen and the pound versus the Kiwi or whatever the case may be. But there are two things that we should know. One is that you can have global inflation, and we have it right now. That's the negative. The other is that the countries who are best adapted with growing technologies and doing new and innovative things and turning their market back on quickly will actually be able to pay off that debt faster. So from that perspective, the US is in a great place because we're one of the most creative, innovative, turn things back on and get going places on the planet. And that's not just my bias, which I have, but it's just historically, we've seen that market turn over and over again. So I do think that we will recover quickly, but we have such a huge blanket that we've got to crawl out from under. It may take a while. That being said, you can expect for at least the next 9 months and probably for the next 24 to 36 months, extraordinary inflation. And I mean extraordinary, right? Extraordinary inflation, higher than what we normally see. And we've already seen in the very first jump in the new year market where no one that I know of predicted, people are saying we could have 3.5% inflation, which would be really horrible. And now it's 7.5. And some people are saying it's going to be adjusted to 7.9. That is massive. That is Jimmy Carter inflation. That is maybe worse than Jimmy Carter inflation. And I have enough gray in my hair that I remember Jimmy Carter inflation. I remember home loans being 18 to 22% interest. So while most assets, this is the concept that we want to roll into the market, while most things do well in an inflationary market, the price of things goes up. So if you're manufacturing and your cost doesn't go quite as much up, but your margins increase, if you're a manufacturer of consumer goods, if you are a producer of energy items, so you'd think energy companies would like this administration and others because the price of their commodity goes up and they're making record profits. It is, and they should. And so that's one of those things where people, they think that they don't like them, but they want to know that they can keep on producing and growing from new production versus just living off of what they have, knowing that they're turning that, they're using up their bank account to sell it out now. So they're getting paid for all of their assets, but at some point they're going to run out of assets if they're not able to drill more. So consumer staples go up, the price of general goods and clothing and what have you, the price of food and food manufacturers, those do well. The price of energy and energy related things go up. One of them that I wanted to spend a couple of minutes though on is real estate. And I've been an investor in real estate for many decades, and real estate prices are going up, and they probably will. And related things, companies that produce cement, companies that grow timber, companies that produce nuts and bolts, saws and tools, all of those should do well, especially if you can find those that are made in the U.S. and they're not dependent on foreign imports, because there may be a shock in that system and it affects their profitability. So whether you're buying ETFs, you're buying stocks or whatever, if it's in your 401k or your retirement plan or your swing trading, those are areas that we want to look at, right? So utility companies, the energy companies, and input companies for infrastructure, which is the timber and the concrete and what have you, consumer staples, and asset-backed real estate. So some of those, this is where we're going to get into a little bit of how you dissect it. So as interest rates are where they are, companies that already have a huge real estate portfolio, as the time goes up over the next 9 to 18, 27 months, they will likely do well because they have assets that they've largely paid for. They built it on, they have a fixed debt. They're paying 2.5%, 3.5%, 4.5% interest on those assets. But then as rates go up, other people can't enter the market, or if they do, they're going to be less competitive when they're paying 4.5, 6, 8% interest, or 10 or 12 or 15, as the case may be. And I think there's a real possibility that we'll see over 12% interest rates in the next 18 months. And but if you have other companies that are raising money right now and they're buying a new asset and it's short term, a 3-year or 5-year loan, in 3 years, as they go through valuation, people that are looking at those companies going, look, they're doing a shorter term note. And if they don't sell it in 5 years, they're going to have to refinance it. And they're going to refinance from 3.5% interest to 8.5% interest. They're out of business. They won't cash flow. So while real estate backed investments are good, you're either looking at buying discounted real estate. So things, and take a step back and think who the largest owners of real estate are. So for example, because I used to be in the hotel business, I think of hotels, companies like Marriott that have gotten crushed because they have large volumes of land that they have to support, keeping those plants growing, keeping those buildings clean and painted, keeping employees paid, even when occupancies were close to zero. And so their stocks have taken a hit. But as things turn around, they will recover quickly, especially if natural rates go up. If they used to charge $250 a night for a room and now they're charging $280 and then $320, their cost of capital won't go up as quickly as the inflation rate. Their cost of labor may, but their other hard costs may not go up quite the same, and they will recover more quickly. So same with other real estate assets, whether it's nursing homes, people that own tons of nursing homes, whether it's commercial buildings, parking facilities, anyone that's a long-term real estate asset should do well. So when I see the markets turn and I see our flow technology says that this looks like it's going to go up in multiple timeframes, and I know that fundamentally utilities, energy companies, infrastructure support, consumer staples, and asset-backed real estate, when I'm looking at those and I see that it's in one of those sectors, then I'm even more confident in buying it. I'm also more confident in swing trading it, holding it long. And so while inflation is especially this kind of inflation is a terrible threat to the stability of banking systems, it's a terrible threat to, and not right now, because they're actually a little higher interest rates, makes more money on credit cards, makes more money for bank spreads, what have you. But when it jumps up real high, it hurts everything. And you could have a major, just like we had in the 90s, you got people waiting for hours like they do in Cuba, wait for hours for gas. You could have banks limiting how much you could take out. You could have government taking over more control of things to try to nominalize that. And anytime the government, kind of like Ronald Reagan was famous for saying, the scariest things you can hear is, hi, I'm from the government, I'm here to help. Anytime we have more active government engagement for something that's a short-term problem, they end up staying around longer than they need, and we end up getting a refractory problem that goes back the opposite way. You'll notice that in elections, right? You get one person that goes far one way, everyone gets upset and they go far the other way. And then they get upset with them and they go far the other way. And so at some point we'll reach normal days, I hope. But I wanted to make sure that we kind of shared this outlook, and I'd like to do the same on Russia on another talk. So I'm going to end this part here, and we've talked about the different sectors that we watch, and then on the chat room, for those of you as encouragement to be on the chat room, I'm going to look for, and I'll ask for you to share as well, those markets or those stocks that you're looking at. And then one of the other things that we're going to start doing, I'm going to put in some trades in the Forex space, because we're going to start seeing more and more opportunity in Forex and multinationals. For those people who are longer term traders or money managers, I would encourage you to look at developing markets as well, because you have large global companies that are timber companies that make concrete, that are food processors, manufacturers, and what have you. And those companies are going to have great opportunities. One of the efforts that we'll be looking at is a merger and acquisition model to go all buy those small and mid-sized companies, give them the dollars to vertically integrate so that they're more efficient and link them directly to markets. And that those models should do exceptionally well over the next 5 or 7 years. But over the next 9 or 18 months, though, we want to look for bullish markets in those sectors that we discussed. So thank you very much for being part of this. I hope that it adds some value, and we'll do more talks on technical analysis and all that. But I just thought this was timely and prudent for where we are right now. Thank you so much. God bless you. And I'll talk with you again soon. See you.